So we've looked at the foundational theory around how to interpret the Market Facilitation Index. Now it's time to put that into practice. Ready? Let's go. The Market Facilitation Index is an indicator like no other I'm aware of. In this episode, I'm going to be taking you through some examples of how it can be used. However, I'll be honest, if you haven't already watched the previous 2 episodes, you're probably going to struggle to follow. If that's the case, and you need the foundation information for this indicator first, then you can follow the link top right now to access those 2 episodes. And if that's the case, I'll see you here again in about 30 minutes time when you've watched those 2 first. For those of you that have already seen them, let's put this indicator to use. So as I said, we've previously looked at both the rationale and also the underlying calculation, and also started to look at the use cases for the 4 different states that this indicator provides us with. Now let's take all of that knowledge and put it into practice. The first thing that occurs to many traders who see this indicator for the first time is, what on earth is this telling us? This just looks like a random selection of different sized bars, all with random colours. How can this possibly be used to give us anything of any value? Well, that's why we need a thorough understanding of what it's telling us, but also knowing how to use it in the context of what the price action is doing at the time. So the first context that I'm going to look at is that of a trading range. Now, obviously, there are 2 main things that can happen in this trading range. 1, we might see the price bounce about within that range, continually moving higher and lower. And often for some mean reversion traders, this is an ideal opportunity to enact that strategy. However, the second thing that we will come across at some point in time is that the price will break out from that trading range. So I'm going to give you an example now of how you might consider using this indicator to give you some clues in terms of the probabilities of whether the price is more likely to hit a boundary of the trading range and mean revert back into the range, or whether it's more likely to break out. So let's concentrate on some of the areas where the price has reached the boundary of the trading range. This is the first one. And here we see a blue bar. Now, if you'll remember, the term given to this state is the fake state. And this is where we see a decent amount of price change, but on very low volume. And those of you that have seen some of my previous episodes will know that with low volume, breakouts are very unlikely to succeed. And so this drive both towards the boundary, but also if you look at the wick of the candle, you'll see that it did attempt to make new lows. Because they were based on one of these fake states, meant that the probabilities suggested it was very unlikely to succeed with that breakout. And as you can see, the price was pushed back into the range and it didn't occur. And so it correctly identified what was most likely going to happen. Let's look at the next one, and again here you can see that the price reaches the upper boundary this time and attempts to go beyond that, but look at the state of the Market Facilitation Index. The colour of the bar is brown, and that represents the fade state. And the fade state means that actually the market participants have lost interest in this particular asset at this moment in time. Now, if the market participants have lost interest, how likely is it that this breakout will succeed? Well, it's quite unlikely. And sure enough, the price got pushed back down into the range. We saw some mean reversion and the price then went all the way down to the bottom boundary. let's take a look at this attempt. And this is the same as the first one, it's a fake state. And just like that first time, this doesn't result in a breakout either. We see a price reversal and the price goes back into the range. But let's now turn our attention to this area here. And let's take a look at these two bars. The bar that develops first is a green bar. And what's more, the direction of the price during this green state is upwards towards that upper boundary of the range. And remember, the green state tells us that the market is being driven by increased market participation. So straight away, we should now be thinking there's actually a chance a breakout might be happening soon. But let's now look at the second bar. And this is a pink bar or a squat state. Now this occurs when we see a much smaller price movement but with heavy volume. And by looking at the volume indicator above, we can see that this is increased to much higher levels than we've seen in the previous 20 days or so. And remember my analogy here. It's like that spring being wound up, and when you release that spring, all of a sudden you have a lot of movement. And in this case, when it does get released, look what happens. The price breaks strongly out of the range and forms the start of a new uptrend. And it was that green state followed by the squat state that gave us the intelligence that that was a lot more likely to succeed than the previous attempts. Okay, let's move on to another example. And here I want to concentrate more on a trending market. So let's start by looking at this bar. And as you can see, the indicator has a value that's significantly higher than previous bars, but also has the green state. And this tells us that there's real purpose and meaning behind this particular price move, which, looking at the price chart, we can see is upwards. Now remember my previous definitions, and I said before that often you can use this state as a filter to determine whether it is acceptable to get into a trend, so in other words it's a meaningful, powerful trend, or whether you should stay out. So it isn't necessarily a signal here. You might well already use signals to get into trends and get out of trends, but this is more often used as a filter to either allow that signal to enact a new position or to prevent it. But as we can see in this particular instance, this leads to the start of a fairly significant uptrend. Incidentally, about halfway through here, we also get another large green state bar from the indicator. And this just confirms that this strong trend is continuing, and as we can see, this means the trend does continue upwards. But let's now focus on this area here. So there are 4 bars worth of data, but 3 out of those 4 are brown bars, which if you remember are called fade states. Now the predominant thing that these fade states tell us is that traders have begun to get disinterested in this particular asset. Seeing a number of these states in quick succession will often indicate the end of a trend phase. And that's what we see, and for a short period of time the main thrust of the trend ends and we see a pullback. So here it's these brown bars that could have given you a clue that now was the time to exit from this trend-based position. But let's move on forward a few bars and look what we see here. It's a repeat of what we saw initially, only this time we get 2 green state bars together. Both of these are supported by upward price bars, which shows there's a real commitment to a continuation of the previous trend following the pullback. And look at the second price bar. It makes a new high, and this is another indication that this might be the start of that next phase of the trend. And sure enough, we see the price continue upwards. We do, however, experience a smaller pullback in the interim period. But once again, look, we had a clue to the fact that that was going to happen. This bar here classified the market as a fade state, showing a short-term lack of interest in this asset, which seemed to be the catalyst for that short-term pullback. So hopefully you've seen here ways in which we can use these 4 different states in order to give us those clues about which way the probabilities are turning. Are they in favor of a particular type of trade, or do they mean that we should hold back and not trade? Now, in terms of the practicalities of this, much of the information we get is similar to what we've seen with the other volume-based indicators. The difference, though, is that it's usually up to the trader themselves to determine what the state is by looking at the relationship between the pattern of the volume and that of the pattern of the price action. And this is the case for OBV, accumulation distribution, and also the money flow index. But with the Market Facilitation Index, the 4 states are predefined as part of that indicator, and they are effectively delivered to the trader as one of those 4 colours. Now, which of these 2 approaches is more suited to you will be down to personal choice. And if you're an algo trader, it will sometimes come down to programming skills. And although I prefer the approaches that are presented through things like the money flow index, because these 4 state values are delivered through the Market Facilitation Index, some traders might find that easier to act on in terms of their trading decisions and rules. But once again, I'd ask you to post your own thoughts on this. What do you find most useful? And also, do you have any additional insights in how any of these indicators can be put to best use? If you do, please just put those comments in the YouTube comments below, and then the wider community of viewers of this channel can benefit from that. Okay, so that now brings us to the end of this mini-series on the uses of volume data. But fear not. Next time we'll be starting a new subject, which hopefully you'll be able to get just as much value from. And so until next time, trade wise, trade safe.